I come from mainstream financial services, by, training, by work. So the first 15 years I did, mostly what, most finance professionals do, which is, join, mainstream financial sector companies to do, either corporate or retail financing. But I would say my shift into a more SME or inclusive finance really happened when I I would say 15 years ago, really encountered financial inclusion and microfinance. So I spent quite some time, 7 years, in really running an operating entity in microfinance. And at the end of it, really wanted to bring private capital into businesses that are really expanding financial inclusion. So that's when I set up Caspian, and initially we set up equity funds. So we were investing in equity of microfinance or other financial institutions. And by 10-12 years of that, we raised significant amount of capital, and we did invest in many of the leaders of today, small finance banks, Equitas, Ujjivan, etc. And then we had done really well as a fund, so we exited those investments. And then when we were looking at what next we can do in financial inclusion, we found this huge gap, which is these professionally managed first generation entrepreneurs with amazing ideas. And India is a huge market, so they saw this huge market. They wanted to expand, and some venture capital and private equity was available. But being first generation entrepreneurs, they also need debt because they need non-dilutive capital also. And we found that many of them, even in spite of having positive cash flows, really had no access to debt, because the financial system does require collaterals. And we'll talk a bit more about it, but basically this was this huge gap of professionally managed, amazing entrepreneurs who wanted to scale up, but were, woefully, lacking any access to debt to leverage their balance sheet. And if you don't have debt in a growing company, you may be running a great business and growing fast, but you don't own anything. Your investors own your company. So it's kind of also came to provide some amount of debt so that they would be able to maintain their ownership and have some access to non-dilutive capital. Debt is available. We have a very well developed banking system compared to a lot of other countries, but there are certain segments that are underserved because the way a traditional financial institution, a bank or a financial institution, looks at debt is in a particular way. So what that means is that you have to fit into a product. You have to fit into all those parameters that the product defines, because only then it's scalable for a bank. And most importantly, while our unsecured lending market has developed, with a lot of banks and NBFCs providing small business loans or unsecured loans to promoters, they all are tailored to micro enterprises. So they all stop at 50 lakhs. And anything beyond 50 lakhs you want to borrow from our financial system today, you need collateral. Now, but we believe that the new generation of growth enterprises will come from entrepreneurs like you and your colleagues sitting behind your camera. So you are the ones who are going to set up innovative new enterprises. And most of our parents haven't left us any collateral for us to go and borrow a 50 crore loan. So where are we going to go and borrow money from? So what is required is to really understand this segment where innovation and growth is going to come. Yes, some growth will come from traditional family-owned SMEs as well, or businesses. There's nothing wrong or bad about lending against collateral, because that's an easy way to leverage your business. But what happens to this new generation entrepreneurs where the innovation leadership is happening? They don't have collateral. So which are those institutions or financial institutions that can do that? And it's not easy because you have to really understand the risk. You have to understand the business. Everybody talks about understanding cash flows, but understanding cash flows of multiple businesses are difficult. And you have to be really patient with growth. You have to do tailored products. One loan is different from. We've done something like 60 different loan types to our clients and that's not easy to do. So we are hoping that our success will lead to others copying us and then scaling this set of businesses that require debt. Of course, they require other forms of capital also. I mean, they do require equity, they do require venture debt, they do require trade finance, etc. But this is an important part that is completely right now underserved by the financial system. So I want to give you two numbers. One is that, see, the ability of an institution to grow and hence raise debt and equity also depends on who your initial investors and lenders are. So the first piece of data we have is 80% of companies or SMEs that we work with, within the next 12 months of lending to them, 80% of them raise more equity or debt. Okay, because it's very important for a business, for a growing business, to have multiple sources of capital and cash flow. So when Caspian goes in, it is seen as an endorsement of the viability of the business plan, quality of the entrepreneur, quality of the business model, etc. But when we go in, almost a third of our clients have no borrowing from any other financial institution, and about half of them we are either the first or the second lender. So it is very. So I mean, you can turn around and say, well, isn't that very risky? I mean, you're going in first, but we are very confident about the quality of the entrepreneurial ecosystem in India and our ability to assess and understand those business models. We are little biased in the sense that, see, our origins come from looking at and investing in businesses that we think are impactful. So we not only, of course, look for financial returns, but we also want these businesses to be doing good while doing business. So we tend to focus on financial inclusion, sustainable agriculture, clean energy, health, education. And of course, we do also work with general SMEs. But our preference is that we want to really kind of focus on businesses that are in these sectors that are what we call impact enterprises, that serve these certain segments of our clients or certain segments of the business, like health, education, financial inclusion, clean energy, etc. So that's our natural bias to work with such businesses and entrepreneurs. We have two very popular kind of products, I would say. One is we provide medium-term loans, where we customize the repayment of our principal based on the cash flow cycle of an enterprise. So let me give you an example. So let us say we work with a education company, which is either, let's say, it is developing a content like curriculum or content for schools, and if they are going and serving these schools, you will see that a lot of the education service or content providers, their payments will come from schools, which is in complete sync with the school cycle, when the school collect the fee. So there is really no point in setting a repayment schedule when, which is traditionally an EMI or a quarterly payment, when we know that they're going to get payments in two bulky kind of periods where the school collects fees from the kids. So that is very straightforward. You'll be amazed as to how many, that why financial institutions don't do that. But it seems like very straightforward for us. So similarly, agri enterprises also have a cyclical nature to their business. So we can tailor make any of those repayments, based on underlying cash flow. Just to note also here, side point, that 97% of the loans we've lent so far, 1,600 crores, 97% of them are collateral free, and we've had a very good repayment track record. Okay, so that's just a side point. And the next most popular is our short-term working capital product. So where, let's say for the same education institution, content provider, let's say that they are going and supplying this to schools, well, they will take 60 days, 90 days to pay. So they need, short-term, but, for the school, they need to pay salaries every month to the teachers. They need to pay rent every month. So they do require short-term, working capital financing. So those are our two most popular products. Because of the demand that we've had, we've just launched what we call a quick loan product, which we really see as a handshake product, where we lend up to 1 crore. So our loan sizes are between 50 lakhs to 15 crores. But this is like up to 1 crore, really quick turnaround using our digital platform, without significantly diluting our due diligence processes. But we should be able to turn that around pretty quickly, and that is seeing a lot of traction, post COVID. Yeah, so we have our own, proprietary due diligence model, which looks at multiple aspects of the business. The prime among ones, of course, analyzing the business model, financial statements, quality of governance, management, quality of investors. We significantly kind of work with companies that have already raised an angel or a venture or a growth capital. So there is, because we are very well connected with the investor ecosystem. So we look at all these aspects, but a lot of our focus comes on understanding the business model, almost wearing the hat of an equity investor, because that's also our DNA, that we really understand, how entrepreneurs think, how business models work, what cash flows they need to meet their growth plan. So we focus a lot on cash flows and business model, and of course we also take into account some of the impact metrics that also we monitor and measure in terms of either number of clients or number of schools they are working with, etc., etc. And of course, recently we've also developed a COVID risk framework, which we put all our clients into that framework, and then see whether their businesses have been, how severely they've been impacted. Of course, most of the businesses have been negatively impacted. To the extent of the impact also we assess through our proprietary, COVID risk assessment model. See, we have a very close, relationship and, with our entrepreneurs. So so it's not that we were, so we are very much, our what we call our monitoring or early warning systems. We collect a lot of data. Our entrepreneurs are also very savvy. They share a lot of information with us. So we are generally on top of what is going on with each of our companies, and it is all individualized. So it is not that. So like I said, every company we know and we monitor what is happening. So it is easy for us to respond, and we respond on an individual basis. So some companies where we think that we have to give them a moratorium, we have to give them. Some companies come and tell us, hey, we don't need a moratorium, but we say, hey, no, we think you need it because, if you just look at how your business is growing, you actually need to put more cash into your business rather than, pay us. Some companies ask for moratorium. We say, hey, sorry, we can't give you because based on our analysis, we think that you can still pay us. That will save you interest. So it's a very individual, bespoke kind of a response. And I would say our clients have been very happy about that. We've also responded with additional debt, the working capital lines that I spoke about. If they have had already limits set up with us, we've allowed them to draw it. If we have to give them some relaxation on some covenants, we've done that. So I think there's no better credit management than understanding your client's business and cash flows. So it was relatively easy for us to kind of respond to those requests positively or negatively. In terms of going forward, how our risk framework will kind of take these into account. It is really, it is impossible to factor in your risk model an event like this. And I would really not encourage financial institutions to do that. Of course, you have to look at external factors in your risk assessment models. But if you want your enterprise or your investee company or a borrower to be resistant for a pandemic, you will never make any lending decision. So it is something that we have to watch out for in our existing portfolio, in our new intake. Look at what additional risks that there are, but I would not envisage us tweaking our risk model to withstand a future pandemic. Then we'd never be doing any business, because it's really impossible to protect yourself against that. Having said that, I'm hearing also from other industry leaders in the financial services system and otherwise, that there has been not an insignificant number of companies who are impacted positively by this. Companies that I would roughly put the number at about between 10 and 20% of companies where they have been able to pivot, whether it is going online, tweaking their product, tweaking their packaging, quickly responding to adjusting their distribution networks. They have actually done better. Well, for example, some branded food companies have done very well. Online education companies that have quickly pivoted to, let us say, higher end education, which is a lot of ways is anyway online. So those are actually doing better. So it is not that there are not some of these businesses and entrepreneurs. We are a very responsive, frugal, innovation system in India. So we know how to pivot with a few lakhs of rupees. We readjust our systems and assets to be able to respond to that, and many entrepreneurs have done that. So see, when they're responding to a business opportunity, they need both. They need equity and they need debt. So wherever there have been such clear opportunities, we have provided additional capital. We have seen equity investors come up, the existing investors of these enterprises come up with additional capital, helping these companies to pivot. So we've seen that happen. But it is also difficult. It's not easy because the human mind standard response is wait and watch, right? Whether you're an investor, whether you're a lender, or sometimes a conservative entrepreneur also wants to say, okay, let me see. I don't want to invest here. I want to see what happens in 3 months. That is natural. But I think there have been cases where the entrepreneur, the investor, the board, the shareholder, the banks, the lenders have responded. Because this, I mean, it's a very clear opportunity that is, that is there, that for the entrepreneur or the enterprise to capture that market share. I would say it's a little bit early, but see, the basic case of an entrepreneur, if the business has positive cash flows, the basic case for the entrepreneur to go and raise cash that is non-dilutive is very strong. So why would you want to sell a part of your company just to get some more working capital or some short-term financing or other financing that you need, that you can raise through debt, which you can service? So that case is even stronger. Also, what is likely to happen is, contrary to what maybe is required, the ability of the entrepreneurs to raise additional equity, either to stabilize their business or to grow their business, that is likely to slow down. Because, like I said, inertia, everybody wants, more data, more information, which is natural again. I mean, it is a lot of their fiduciary responsibility to do that. So then in cases where they need another 6 months or 9 months of headroom before they need more equity, debt is a clear answer for them to be able to continue to either stay where they are or grow moderately without raising equity, because the equity markets will take some more time to come back and start looking at new deals. See, I think first of all, many of the schemes that have been announced have been very thoughtful. I think the focus not only has been on providing liquidity, but also the most important thing that we as an industry felt, and what the schemes have responded well, is on risk protection. Today, it is an equal issue of liquidity and cash flow as well as risk. It is not that the system does not have liquidity. The system has liquidity, but in a like in any post kind of a crisis situation, risk becomes paramount. So all the risk protection guarantee and all the others programs that have been announced are absolutely, they are going to lead to the cash flow going into these enterprises. What I would say has been announced, but needs a little. It's a little complex, which is that a lot of the SMEs require equity type of money. See, it is not a large number of them are going to attract outside capital, but they need for them to stabilize their business, because they've all also lost a lot of money. They've burned cash. So you need to re-up your capital before you can stabilize your business and grow and get other forms of cash like debt, etc. But it is so you need a product that will be like equity like to the SMEs, which also the government has announced, where it is saying that it will provide equity or risk capital to these SMEs. It is very much needed, but I think the equity schemes that were announced to SMEs in the past haven't taken off, because they have basically taken a traditional approach to assess equity. And if you use a traditional approach, most of these SMEs will not qualify. So while the idea is good, I think that is a gap that will really bring stability to the SMEs that have been rocked by this shock. So I would say, if I have to pick one thing, I think the equity scheme that the government has announced to the SMEs, that money needs to be innovatively, kind of invested out. Not at this time, other than venture debt, because that requires a different type of capital for us to be able to do that. We need really long-term money. While we do have we are very well capitalized, and with long-term funds that we have ourselves, but we would need a different type of capital on the liability side. So at the moment we don't have that. To whatever extent we do out of our equity funds that we manage, but not out of Caspian Debt. So we like to call ourselves a corporate digital lending organization. And we've spent the last year and a half to really bring our proprietary assessment, analysis, and other processes completely digital. So the journey for our clients also will be digital. So they basically apply online, give us all the data digitally, which 70% of that we process using our own digital platform. So there is only like a 30% of human intervention or analysis. So our system does the even the proprietary analysis that I spoke about, which is our strength. Most of that is done by our systems and processes using our proprietary appraisal and analysis tool. And that, what does that do is that basically cuts down our turnaround time. We are able to analyze a wide set of data, do a comparison analysis of other companies or other business models of a similar nature, and dramatically improves our ability to monitor these businesses on an ongoing basis. Because that is also a big part of how we manage our risk, and also how we grow with our entrepreneurs is our ability to kind of get data from them on an ongoing basis. So it is all of this that we are doing, and our companies and entrepreneurs love it because they are also very digitally savvy. They are able to provide a lot of this information. We are able to access information other than company specific information. And of course, turnaround times are quick, and we don't keep calling them 10 times for information. It's all pushed to us digitally, and that's how we analyze. So we hope that this will help us scale up significantly without diluting our individual nature of how we deal with our clients. In terms of industry segments, I think the segment, of course, we cater to, but I think there is a massive gap is businesses that are asset light. Traditional financial institutions really cannot respond to asset light business models that use gig workers. So how if we think that is the future, how do we really respond as a financial system? Yes, equity investors have responded well, but as our lending institutions responded well. So because it is of course higher risk, but it also requires effort to understand them. So that the new age economy companies are a big kind of segment that I think a lot more debt should go into. The other is, I would say, really product-based approach that most of the banks and financial institutions have taken have gone that far, but it is very hard for them to service enterprises that are fast growing, that really don't meet a product specific framework. So these are more generic, I would say, SMEs that I'm saying. More specifically, I think the post-COVID, I think the demand for more sustainable products or services will increase. So whether it is, clean energy, energy efficiency, um, efficient transportation, etc. I think we've all become a little bit more conscious about a sustainable way of living. And suddenly we've also realized that, well, we have so many things that we don't need, but some of the things we need, we don't have. So I think in terms of businesses that will get more valuable and get more attention are businesses that are really more sustainable, which I think will grow as an industry or as a segment.